Well, welcome to Stock Talk with Nico Criticos. Today, we're going to be going over Okta. This is a newer company I've been looking at, and they are a Saas company. Right now, they're trading at a $30 billion valuation. Over the past year, the stock price has dropped 30%. And today, we're going to do some analysis on if I think this is a good stock to buy or not. I'm not a financial advisor, but just informing you with some information here. So they are partnered with over 13,000 companies, including Google, Microsoft, Amazon, and Salesforce. Over the past 3 years, their revenue has more than 2x'd, which is quite amazing. Their CEO says that their total addressable market will be $80 billion. And the way I look at these numbers is if they can continue to, right now they're growing 53% in revenue this year expected, and then 37% for 2023. So they can continue to grow for the next 3 years at about 35%. Then 2025, we'll see $3.2 billion of revenue. And after that, revenue growth is going to slow because it can't grow that much forever. So let's say it comes down to 25 to 30% after that. Then at that time in 2025, the price to sales will be about a 15. It'll be somewhere probably between a 12 to an 18. A 15 would be a fair value. And 15 times 3.2 billion of revenue, it will be $48 billion this company will be worth in 2025. So this is $313 a share or a 60% return from 4 years from now. I don't think that's underperform. That's probably underperforming. That's not very good. 60% return in 4 years is it's not bad, but it's not great. So right now, I think this company is actually fairly valued. If I had to pick a valuation for this company, I pretty much would price it at $30 billion because if they are growing 53% revenue this year and they're doing $1.3 billion in sales, then a $30 billion market cap would be justified. If we look through the checklist, we can see it is down over 30%. That's going to get a check. They definitely get a revenue increase. They did $835 million of revenue in 2021. And how I said over the past 3 years, they more than doubled revenue. And then for net income, they're not profitable yet. Net income has been going down. They still are losing money. Price to sales, how I said a price to sales of 23 for this year with 53% revenue growth is healthy, is in line with where it should be. And then of course, price to earnings is going to get a no because it's negative. Does the company have a moat and are they innovative? This one was kind of tough. I put no because on their website and stuff, it says that they're the leader in the identity cloud platforms, but if you look at something like this website, it shows these other companies like Persona and Microsoft actually above them. So these other ones have 35% market share. Okta has 2%. However, I will say this is probably a couple years. This is probably 2 years, 3 years old because it says they have 2,700 companies using them when, how I said at the beginning of this, they actually have over 13,000. So the market share today for them is probably more like 10. It's probably more like 11% market share for Okta today. But you still have these other companies like Microsoft and Persona competing with them. And so I don't really, I think Okta is probably the leader in a certain designated category, maybe a certain field they operate in. Maybe they're the leader, but not necessarily for just any, all this identity verification. So they do things like multi-factor authentication, and they work both on the business side of things as well as the the customer side of things. So here's all their different products and services. And so they work with IT. They help you. They make sure that they're checking people's identity and doing things like that. So it's a cloud SaaS company. And if we keep going, we can see the industry is growing for both cloud and for software as a service companies. All these profitability metrics are going to be no. Diverse revenue streams, I would say it's diverse in the way that they're offering services to workforce and to customer identities, but that's really it. It's just software as a service to offering these things to customers and their companies. But that's really all they don't have any other products or services. So it depends how you look at it. That one can go either way. If we go to the balance sheet, there are more long-term assets and liabilities, as well as current assets and liabilities. That looks good. And then this one, this metric, I came up with this the other day, and I'm still kind of debating on how I should do it. But I put, does it have high equity relative to the market cap? And I put yes, because they have 20% of their market cap is how much they have in equity on the balance sheet. So the company is worth $30 billion, and they have over $5 billion in equity. So that's pretty good. Some big tech companies like Apple only have 2%, 4%. That's on the low end, and then normally most companies will have around 5 to 10% of their market cap value on the balance sheet and equity. Then finally, we have is the equity increasing, and yes, I'm thinking this is because of acquisitions, but the equity went from in the past only a couple $100 million to, how I said, it jumped to over $5 billion. So I'm thinking that's from acquisitions. I can't imagine what else would cause that big of a jump in equity, but it seemed like that really helped out the stock price too. If you look at the past few quarters, it was 600 million this time last year, and now today we're probably around 6 billion in equity. And so all in all, we get, and then we also have there's no really strong share buybacks or dividends. If we want to look at this is going to tell us what hedge funds are doing with the shares. There's definitely has been, for this past quarter, there's been more buying pressure than selling pressure, which is a good sign. That explains how the stock price has this past year it's been bad because it was almost $300 and now it's 200, but over the past 5 years it's been phenomenal. From 2017, a $24 stock, to now 200. That's an excellent return. But so there's definitely more buying pressure on the stock. As you can see here, 2.5 billion shares bought from this company, 1.9. And if we change it, here's the company selling the most amount of shares. Those numbers are dramatically less. Insiders over the past couple of months, not really. They sold a lot in November, and then since then there hasn't been too much buying activity. Because I don't really think the stock is a good deal. I wouldn't say it's a good deal to buy at 196. I would say it's fairly valued. So if it dropped down to 150, then I think it would be a good deal. But at 200, it's really just fairly priced. And then finally, we have, is it founder-led, and do they have good management? I put yes. Multiple executives are co-founders. And I watched some interviews with the CEO. I don't know a ton about him, but looks like he knows what he's doing. Obviously they've done a great job growing the company in the market cap, so that's good. They're still working on profitability metrics though. That's the problem. Now, finally, so overall the score is 11 out of 18. Once again, not considered a buy. And then we see this is comparing earnings and revenue to other similar companies. So Ping actually is pretty much a direct competitor. Ping Identity, they're also doing identity solutions and things like the multi-factor authentication, and the company is much smaller. This company is only $1.7 billion. But if we compare it, we can see that Ping is actually growing EPS a lot more than Okta. They're actually profitable. And as far as price to sales growth is not growing nearly as fast as Okta. But so you can see, so Ping is a quarter of Ping's forward price to sales is 1/4 of what Okta's is, and their sales growth is kind of similar. So that makes sense. Looks like both of those are pretty fairly priced. And then you have other companies like CrowdStrike and Mimecast, not direct. I don't know if I want to say they're direct competitors, but they're both in the cybersecurity business, and they also work with the cloud and making money through that segment. So it's similar, and they're also a fast growing company. So similar, I think they're a good comparison. So you can't really compare Okta on a PE metric, but if you look at the price to sales, you can see that it's pretty much in line. This CrowdStrike trades a little bit richer, and that's because they're growing revenue a little bit richer. It doesn't mean CrowdStrike doesn't mean that's a great deal either, but it's in line with where Okta is. And then Mimecast is it's a little less than half, and their sales growth is a little less than it's about half. So all in all, it looks like Okta is fairly priced at these prices, and it looks like they're, fast growing company, good business model. Only thing is I wouldn't consider it a deal unless it was near $150 a share, but at $200 a share, I think this is a fairly priced stock.